Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm Paul Peebles, National Underwriter at Old Capital. And of course, with me today is Michael Becker, Senior Director at Old Capital.
Hey, Paul.
Mike, I'm excited to have Andrew Patton for the podcast today. Andrew brings kind of a unique background. He did a lot of single-family investing before he started to get into multifamily investing. But one of the things I want to kind of talk about a little bit, because as everybody knows, we are bankers, is what happens when the equity is out of state and the boots on the ground are here locally. How tough is that to try to get through the system where the equity is, let's say, in California, but the boots on the ground are in Texas? So, Mike, give me a little bit of your perspective right now on that.
Sure, Paul. One of the bigger challenges that you alluded to is a lot of times we have clients who are based in, say, California, and the property is located here in Texas, and the lenders get a little bit uncomfortable that the oversight might not quite be there, and they don't have full control around the property. So one of the things that we helped in Andrew's case is we helped get him set up with a group that had some money, and then he was here locally, and he asset manages the deal, and he's the boots on the ground. He's overseeing all the construction projects, etc. And that was one of the requirements that the lenders had of it to get the deal done, was that we had someone here locally, paying attention to the deal.
Well, you would think that California is a different country when it comes to lending in some different states, but it's not. California is part of the United States. But when you're dealing with people that have money from, say, California or Florida or New York or wherever, and they're looking to invest in properties, let's say in Texas or in New Jersey or in Colorado, some of the community banks want to make sure that the borrower has the boots on the ground that's going to take care of their asset. Because remember, the bank is your partner. The partner wants to make sure that you have control of the transaction.
Yeah, Paul. So I think one of the things that the listeners will hear today is Andrew and kind of how he structured around some of these challenges and got a few deals done. So without much further ado, let's just throw today's interview.
And thanks, Mike. Andrew Patton is with us today on the Old Capital podcast. And we always try to start off with the end in mind. And Andrew, we're looking up on the board here how many properties Andrew owns or controls, and it's about 900 doors. Andrew, welcome to the podcast. Tell me a little bit about yourself.
Thank you, Paul. Well, a year and a half ago, I didn't know I was going to be in 900 doors. So that is a surprise to me, and a good one.
Tell us a little bit about what your background is. I mean, the 900 doors that you own, they're in Texas. Specifically, they're in the Dallas-Fort Worth area. Tell me a little bit about 4 years ago, what were you doing? 3 years ago, what were you doing? 2 years ago, what were you doing? And now you own 900 doors in Texas.
Sure. So I worked for a global investment company for 10 years. I was a project manager. Wanted to get out of the corporate world. I went into flipping houses in 2004 and did that for 8 years until 2012. And then in June of 2012, I actually met you, Paul, at this very office.
Okay.
And started talking about getting out of single family and flipping houses and getting into multifamily.
So you were flipping houses in Texas and where else?
In Oklahoma and primarily in California.
So your background really is that you had a corporate American job in the financial services business. You saw an opportunity back in maybe 2008, 2009 to buy some of these distressed assets. You bought some of the distressed assets with the intent to rehab the properties, flip them, and then the inventory became too tight in California. You picked up your family, and your kids to Texas. Had you ever lived in Texas before?
Never. I've flown through DFW Airport, but never had gotten out of the airport.
So that was a little bit of a leap of faith, huh, to come to Texas?
It was.
So then you were transitioning from single family. You saw the value of buying multifamily properties, kind of economies of scale. and now you own 900 doors. So kind of walk me through. We had a conversation 2 years ago or so, and then you now are into, how many rooftops is that?
That's a total of 8 properties.
8 properties. So some doors, there's 100 doors. Some doors, there's 38 doors, and some doors, there's 244. So we'll kind of go through the details here in a second. But your first transaction, how did you get into that first transaction? Why did they need you, and how was that put together?
Well, the first transaction was a group of California investors who wanted to buy a property in Arlington, Texas. But because of the whole meltdown in 2008, the regional lender was very apprehensive about having nobody in the deal that was local. So I happened to be local. I happened to have had 8 years of full-time real estate investor experience, and I was just at the right time at the right place to be the local investor that they needed in that deal.
On this transaction, is that the property was
20 units.
120 doors in the property. The California investment group that wanted to buy it could not proceed with the acquisition because they had nobody that was from Texas in the group, and most of the banks wanted somebody in the ownership structure that was from Texas, and that you happened to fill that need. So you became the asset manager. You put some money into the transaction yourself. The majority of the equity came from the California investors. And now you guys got a loan on the property. And the bank that did it, what kind of terms did you guys get?
The bank gave us an interest-only loan for 1 year. It was a bridge loan to get us into permanent financing, but it also came with a option to renew the loan for 2 additional years and convert to principal and interest. So we are about 9 months into our second year, which is principal and interest, and our goal is to refinance into a Fannie Mae permanent loan before the end of this year.
So you're looking to go from a recourse loan, which is a bank loan, to a non-recourse Fannie Mae loan. You're going to try to pull out some cash, but really the purpose is to try to make it a non-recourse loan and go with a 30-year amortization. Is that right?
That's correct.
Okay. So that was deal number 1. And so even before deal number 1, you were on to deal number 2 and 3. Tell us a little bit about deal number 2.
Well, deal number 2, I was actually in contract and closed just a couple weeks after deal number 1. Deal number 2 was a deal that I had sourced on my own, put the deal together, and went with a national lender on that. It was a 25-year amortization loan, interest rate fixed for 7 years, had a 5% interest rate, really great loan. And both of these loans, I was able to get significant rehab money from the lender as part of the loan, which is really critical in order to reposition the assets and be able to increase the rents and increase the profitability of both of these deals.
So those 2 transactions were done with the help of Old Capital. And now tell us about deal number 3.
Deal number 3 was out-of-state investors, same as deal number 1. They needed a local Texas investor in the deal, and so we were able to put me into the deal as the local investor, and that was a very clean deal. Had a property management problem, which was creating a drag on occupancy, and so that was a fairly easy deal as far as being able to raise rents 10 to 15% with improved operations.
So the first deal you did was 120 doors. The second deal you did was 38 doors. The third deal you did with this Longhorn Cove property, which is a series of duplexes.
It's 33 duplexes all in one subdivision. So we bought the entire subdivision and we run it like an apartment complex.
Okay, and you did Fannie Mae financing on that one. So you went from doing, say, 2 bank loans. Now you had enough experience in the eyes of Fannie Mae with the help of maybe one or 2 of your partners in the deal that had some Fannie Mae experience, that you were able to sign on a 30-year loan, non-recourse, 10-year term transaction. So that one, it was a clean property that was built in the 90s or 2000s?
It was actually built in 2010.
So just a couple years
Yeah.
It's only four years old.
It's really a Class A property in a great location. And we were able to, it came with some vacant land. We were able to do some value add and add some amenities that you would typically see at an apartment complex, so that it's not just a subdivision of townhomes.
Sure.
We were able to put in some outdoor fitness equipment from Colorado, which is really cool. We were able to put in a pergola and barbecues, a soccer field, a dog park, different things that'll make it more enticing for people to want to live there and stay there and make it more of a community than just individual houses.
So on the second one, that was regional bank. Third one was Fannie Mae financing. Tell us about deal number 4.
Deal number 4, I was able to source that deal locally and put it together with Texas-only investors. It is 46 doors, built in 1970. We went in there with a national lender, Old Capital, put the financing together on that. The big part of that was the property was rough. You were able to get us, $250,000 in rehab money on a small property of 46 units. And we were able to radically turn that property around. So we've owned it as of last week, exactly 1 year. And it has 44 occupied units out of 46. And we've increased rents 10 to 15%.
Wow.
And completely turned that property around.
That's amazing. So you've owned that property just in a year, and it's 90% occupancy with increasing rents 10 to 15%. So that's a success story. Do you remember what the interest rate was in that loan?
Yeah, it's 4.85% fixed for 5 years.
Okay.
And it was interest only for the first year, and it's amortized over 25 years.
So during the rehab portion, you have the interest only. Takes a little bit of the burden off the operator, so they can go in there, rehab the property, and then they don't have to count upon trying to fill the property up with, say, bad tenants. They want to find the right tenants during the period of time that it's the most critical.
Right.
So now the next property was, what was the name of that one?
Courtyards at Mustang in Grapevine, Texas.
And how big was that deal?
228 units.
So now I would think at some period of time you're starting to run out of your own cash. How did you structure that transaction?
So in that transaction, I actually, because now I had a track record of success, and the investors in deal number 3 saw the value that I brought to the table. When I did deal number 5, I was able to put no cash into the deal for myself, but get an equity stake in the deal so that I'm highly motivated to make the deal successful.
So what I'm starting to hear is that these California investors, or these people outside the state of Texas, are asking you to become partners with them because of your track record, and they're not having you to put any of your additional cash into the deal out of your pocket, but you still retain an ownership interest in the transaction, and you're the kind of the boots on the ground that you kind of oversee the management company that manages the property. So when they fly in, you're the go-to person. You're the decision maker on behalf of the entity. You're the managing member.
I am the managing member, yes.
So you're the managing member. So the investors have put their faith in their money. They've given a piece of the transaction to Andrew. So when the property is either refinanced or sold, Andrew gets equity out of the transaction. So, and how's that property doing?
Well, these investors are going to do really, really, really well. So that property, we took it over it's coming up on a year. In a couple of weeks from now, it'll be a year. That property runs 3 or 4 vacant units out of 228. We've been able to raise rents, again, 10 to 15%. We were able to get a rehab loan, or part of our loan had rehab funds of almost $1 million. It was an $11 million property.
Wow.
And, we were able to go in there and we put in 2 basketball courts. We put in commercial grade children's playground, did solar screens, did barbecues, did pergola, did a whole, a remodel of swimming pools, completely repositioned this asset, and we're reaping the benefits now. And I personally handled all of the rehab oversight, as well as, managing the asset, as hiring the property management company and overseeing them and making sure they're doing a great job.
How much time are you at the property, physically on the property, or on all your properties?
Okay, so I visit all the properties every single week. touch base with the on-site management team. I don't want to just get my updates from their corporate office. And there's tremendous value to that as well, because we actually did go through a change of property management company. So we bought that property, 228 doors, in September of 2013, and we had to change property management companies in February of 2014. And I saw some issues with the management company, and I was able to quickly go out and interview other companies. Because I'm local, I got to get the scoop from mortgage brokers, other people in the industry, to find out, who is now currently the best at property management for apartment complexes.
Okay.
And we were able to get a new company in there and make sure that there was no issues.
And so the bottom line is that property's doing much better today.
It's beating our pro forma.
Fantastic.
Yep.
All right. And then the next property was called what?
Holly Hills, and it's 100 units. We purchased it in October of 2013. Again, that was a Fannie Mae loan, so non-recourse loan. California investors. We were able to get rehab funds of approximately $500,000. And same thing, go in there, remodel the swimming pool, put in an outdoor patio area, paint the property, put solar screens on the property, put a dog park in.
Wow. So you're really updating these properties. So you're taking a property that's been maybe a little bit tired, a little bit old, a little bit outdated, and people who owned it had really never put a lot of money into it. So you're kind of putting Humpty Dumpty back together again. And by doing some of the interior rehabs and the dog park and some of these extra amenities, you're making it a much better product on the street to get the better price for the tenant and getting a much better tenant that's going to stay there a longer period of time. So tell me a little bit. I mean, we've kind of glossed over a couple of these deals. You've done a lot of transactions. Last couple of transactions, are the investors making money? Has this been a pretty good investment for them? Are you pushing out checks to them?
We are pushing out checks. Usually we don't push out any checks for the first 6 months to 12 months because we're doing the rehab and we're repositioning the property. At that time, we're changing the tenant base. So we usually have a decrease in occupancy before we ramp it back up with the tenants that we want, which are a higher caliber tenant, a better paying tenant. So first 6 to 12 months, no owner distribution checks. But then, like that property we were just talking about, Holly Hills, we bought that in October and we started owner distribution checks in March. So about 6 months later.
So the last property you bought was, what was the name of that one?
It's called Forest Ridge Apartments, 56 units, also bought in October of 2013.
And why did you guys like that transaction?
We liked it because it was across the street from the Holly Hills apartment complex. So we were able to purchase both properties and then run them out of one office and get further economies of scale.
So they were, before you bought them, they were being run out of two separate offices?
They were being run out of one office, and we wanted to further leverage that by changing the tenant base and continuing that. So the seller actually owned both properties, and we were able to purchase both at the same time.
And I've driven by that property recently. I think what really stands out in that deal is that you guys have done the parking lot and done solar screens to the property. So when you put solar screens to the property, people think of it as like these black or thickly meshed screens that keep the sun out. But probably the biggest benefit for owners is not only does it try to save you on electric or appliance utility bills, but it cleans up the look of the property. So a lot of these units have blinds on the property that maybe the cat or a small dog is torn up, but you put the solar screens on and you cannot see the blinds that have been torn up. So it puts a much cleaner look to the property. And that last property, the Forest Ridge property in Holly Hills property, really looks great. You've done a wonderful job of putting those two transactions next door to each other and brought new life. And how are those properties doing?
They're both doing really well. Holly Hills is, as of yesterday, I was at the property yesterday, is 95% occupied, so it only has 5 vacant units.
Wow.
And one of those 5 is already leased, so it's 96% leased. Forest Ridge is 100% leased, All 56 units are leased, and there's only 2 that are vacant on Forest Ridge.
So not only are you an asset manager, but also too, you also put your money into being a passive investor into deals. Tell us a little bit about a passive investment that you made.
Well, back in June of 2012, when I first met with you, Paul, you're really good at connecting people in the industry. So the other investors who were already doing what I am doing now, I was able to team up with them, and because of their track record of success, I was able to make a passive investment, which was actually my very first investment into the multifamily arena, just to see if this is for real. Can you really make these kind of returns? What do you need to do to make these kind of returns? I wanted to see what somebody else was doing and get my feet wet. So I went into that deal as a passive investor, and that deal closed in December of 2012, and they're most likely going to bring it to the market and try to sell it possibly by the end of 2014. So it'll be about 2 years.
So in a future podcast, we'll talk with Kim Radiker and Will Crozier, who own that property, and kind of get their 2 cents. But on the high level, they bought it at $14,000, $15,000 a door.
Correct.
It was about 50% occupied. We provided the bridge loan, so they acquired the property with our money. They did $1.5 million, $2 million worth of rehab dollars into the property. They rehabbed the property, and now they stabilized the property, and they're going to bring the property to the market. So any idea what they're going to try to sell the property for?
I don't have any idea, but I do know that their return on investment is going to be crazy.
Yeah, so I think they spent $14,000, $15,000 just on these units. It's a pitch roof, 244 doors, nice property in a good side of town. The group that owned it before were bad managers, bad owners on the property. The group that owns it now put another $8,000 to $10,000 a door into the property, and they'll probably sell it for $40,000, $42,000, $43,000 a door. So that ownership group, that Andrew's part of it, will get a large capital gain. And I guess you guys have to make a decision whether you're going to buy another property or pay the government.
Yeah.
So tell me a little bit. So you've gone from 0 to almost 900 doors or so in a matter of 18 months. I mean, do you like the business? What don't you like about the business? What would you change? What would you do different?
Well, I love the business. It's more than I ever thought it could be. I've gone faster than I thought I could go. I stopped flipping houses in June of 2012. So after I met with you, Paul, after that meeting, I decided I was done with flipping houses and I was going to go 110% into multifamily. So the light bulb went on. The light bulb went on as far as the difference between multifamily and single family. So in single family, especially when you're flipping houses, you make your money on the purchase price.
Yep.
If you cannot get the right price, you're going to lose money. And your profit is all dependent on that purchase price. There's nothing you can do to change it. So if you buy a house and it's a $150,000 neighborhood, that house is worth $150,000. You can't make it worth $200,000 or $250,000. But with apartments, you can, because apartments are valued as a business. Mm-hmm. So it's the simple valuation is, what is the net operating income? And you divide that by the cap rate of what the going rate is of return that investors want off of an asset like that. And that's the value. And so you get rewarded for being a really good manager. The better you can be a manager, the better rewarded you're going to be, because you just need to increase income and decrease expenses.
Right.
And if you can do that and do it consistently month over month over month, then someone's going to buy that business from you, and you're going to be rewarded for your hard effort. So that is extremely appealing to me as an investor. After flipping houses for 8 years, you get tired of having to find your next deal, find your next deal, find your next deal, find your next deal. With apartments, you get economies of scale. So you don't have to, because I used to flip 60 to 70 houses a year.
Wow.
With apartments, you look at what's up on the board and we go, wow, Andrew, you purchased 7 properties in 1 year. That's a lot. Well, it's 10% of what I used to purchase in a year. Yes, they're bigger transactions, but I can do fewer and make better use of my time.
Right.
And run them as businesses and then exit them either with selling them and doing a 1031 exchange into something else, or refinancing and taking some of the profits out and keeping the asset. But you have that residual income of every month knowing you have income coming in. Whereas with flipping houses, every month is something different. And you don't know where that year is going to be or that month is going to be. So the keys for me were, number one, meeting the right people. So you are a critical part of that because you have over 20 years in financing multifamily properties. The key to that financing piece is being able to have enough rehab money up front to be able to reposition the assets. Because if you don't have enough cash up front, you can't get these 10 to 15% rent increases because you can't make the property that appealing. So if you buy it and you don't put any money into it, you should get about the same rent as the seller was getting.
Right.
Because you haven't changed anything.
Yeah.
You haven't moved anything. So a big part of the success is the financing piece, which you bring to the table. The other keys is knowing what to do to the property and how much to put into it and where to spend the money. So the lender will look at your due diligence inspections and they'll tell you, okay, these are the repairs that we want you to do, but they don't tell you, we want you to improve the property by adding amenities. That all comes from myself as an asset manager of where we can add value. The lender doesn't tell you that. They just tell you what you need to fix, what's broken needs to be fixed. But to improve the property, that is just your own intuition, your own experience of what works and what's the best return on your invested dollars. So that is critical to the success. And then with that, the most critical piece is your vendors. You want to have your subcontractors who are going to do the rehab for you on budget, on time, and do it in a quality manner. Mm-hmm. So if you can't be going out to the property almost every day for that first 6 to 12 months when you're going through rehab, you can't keep tabs on that.
Right.
And you don't want to be going and finding a different subcontractor in the middle of something. You want to make sure you've got dependable subcontractors to make that happen. That's a critical piece. And then, the last critical piece is the property management company. You have this $10 million asset or $5 million asset, and it's being run by 2 or 3 people in the office and a couple of maintenance persons. And your asset is dependent on their skill set of doing a good job.
Right.
And so you want to be very selective in your property management company, and things change. Property management companies lose key managers who oversee the on-site staff, and then the on-site staff deteriorate, or they get very popular and they become very busy, too busy, and they take on too much business and they can't properly oversee it. So just because you have a good property manager in place today doesn't mean that's the right property manager for you in 6 to 12 months.
How fast will these things fall apart if you're not paying attention to them?
These things can fall apart in 90 days.
Yeah.
They can really fall apart really, really quickly. And if you start to lose tenants and their repair requests are not being done, and then they start to tell people you don't want to live here, et cetera, it can really set you back. Mm-hmm. And that's if you move quick enough to change out the management company.
Right.
If you don't move quick enough, you could end up having to fire sell that asset to get out of it just because your occupancy drops and you don't have the revenue to cover your operation expenses.
Anything more that you'd want to add to that?
No, I think the most important thing for people who want to get into this business or who want to have above average returns in this business is get to know the right people and get to know the right lenders are very, very critical in that role. And so someone like you would be an integral part of their team, and then you want to have the right asset manager in place, and you want to go after the right properties. If you buy a Class A property, it's going to have a different return than a Class B property or a Class C property.
Sure.
And my niche is I go after Class C properties and I reposition them to a C plus or a B minus because for me personally, that's where I find the biggest return on investment. That's my niche.
And what's your typical bogey for a rate of return? What are you trying to shoot for?
The rate of return we try to shoot for is 100% return on invested dollars in 5 years or less. So that includes profit checks plus the capital gain at the end. So if you cumulatively take that amount that was paid back to the investors our goal is 100% return in 5 years or less.
Okay. So that's what you're going in with.
Yep.
Okay. All right. Well, that's been Andrew Patton. And tell us the name of your company, because I think it's neat. What is the name of the company?
So my company is called Antrim Properties, LLC. So Antrim is A-N, like Nancy, T for Tom, R-I-M for Michael. And I was born in Northern Ireland, and I was born in County Antrim. So I named my company Antrim Properties. I don't speak with a Irish accent because I left when I was 6 months old. And but I'm the first person in my family tree that has left the island, and I've lived all over the world. And for the last 20 plus years, I've lived in the USA. So, I named my company after my roots.
I think that's great. All right, Andrew, we appreciate your time, and good luck. Boy, what a breakout for last 18 months, going from really zero to having almost 900 doors under either asset management or being a passive investor in. You've done a fantastic job, and we appreciate you spending some time and bringing everybody up to speed about what you're doing. So I'm going to throw this back to Mike, and we'll talk to you soon. Thanks.
Thank you, Paul.
Thanks, Paul. I really thought that was a great interview today with Andrew. In a really short period of time, Andrew went from no multifamily ownership to nearly 1,000 units. He really did it by identifying a problem, coming in with the solution, solving it, and it's really carved out a nice niche for himself, kind of being the local boots on the ground to help out estate equity, take down properties here in Dallas. I appreciate everyone listening to today's interview. If you really want to find out more about us, please go to oldcapitallending.com, or you feel free to email me at mbecker@oldcapitallending.com. Thanks, and we'll see you here next week with another great interview.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.